After hoarding a mountain of cash for what feels like an eternity, Berkshire Hathaway just dropped nearly $20 billion back into the market. And the centerpiece of that move? A massive $17 billion shift directly into Alphabet. So, what exactly is the smartest money in the room signaling right now? Well, we're diving straight into the data from their latest 13F filing to find out, because what they are telling us here is huge, and it's definitely not what the casual observer might think.
To really grasp how massive this pivot is, you gotta look at the setup. For 14 straight quarters, Warren Buffett's conglomerate was a net seller of stocks. Just let that sink in for a second. For 3.5 years, while the rest of the market was rallying and hitting all-time highs, Berkshire was basically sitting on their hands, patiently hoarding cash. They completely refused to chase elevated valuations. It was honestly a masterclass in capital discipline. But then, the second quarter of 2026 rolled around. Under the operational guidance of CEO Greg Abel, that massive, dormant cash pile suddenly woke up. They deployed nearly $20 billion into equities. And they didn't just sprinkle this money evenly across the board. They made a definitive, aggressive $17 billion pivot, anchoring it with a massive bet on Alphabet, along with a huge stake in Delta Airlines.
Now, before we get into the exact trades, let's remember who we're dealing with here. Berkshire Hathaway doesn't just buy whatever tech stock is trending. Their entire style is built on buying structural monopolies, businesses with massive cash-generating infrastructure and a very heavy margin of safety. So when a value investor of this magnitude suddenly pivots hard into AI infrastructure and cyclical transport, that is incredibly revealing. It tells us they see durable cash flows where the rest of the market might just be seeing volatility.
Let's break down the actual accumulation that took place in Q2. They added over 48 million shares of Alphabet. That's a $17.1 billion move, rocketing the Google parent right up to their third largest position overall. On top of that, they executed a massive 44% boost to their Delta Airlines stake and increased their Class A holdings in homebuilder Lennar by nearly 30%. Basically, they're aggressively loading up on digital and physical infrastructure.
But of course, that capital has to come from somewhere, right? To fund these massive bets, Berkshire was actually quite ruthless in trimming the rest of their portfolio. They cut over 30 million shares of Bank of America. Even more dramatically, they slashed their Capital One stake by a whopping 58% and completely exited Constellation Brands. This looks like a very conscious shift away from unsecured consumer credit risk, reallocating all that capital directly into high-margin tech and transport utilities.
The absolutely crucial thing here is separating the real signal from the noise. Look, when you manage hundreds of billions of dollars, a tiny new position, like the 3,500 shares they bought in D.R. Horton, which is only worth around $500,000, that's likely just internal watchlist noise. But launching Alphabet into a 12.6% allocation of their entire public equity book, there's no way around it. That is a definitive, high-conviction signal. You simply don't commit nearly $40 billion just as a hedge.
This move perfectly illustrates the strategy we're seeing in the Greg Abel era. Analysts are calling this a definitive transition toward a dual-core tech allocation. They already have Apple acting as their massive consumer ecosystem moat, and now it looks like they're treating Alphabet as their foundational cloud and computing utility. They aren't looking at Google as some speculative AI gamble. They're treating it as a dominant digital utility with unmatched infrastructure.
And honestly, here is the most fascinating detail of the entire filing, the ultimate proof point of just how high their conviction is. About 60% of this Alphabet purchase wasn't even executed on the open market. $10 billion of it was structured as a private placement directly funding Google's AI build-out back in June. Think about what that means. Berkshire stepped in as a capital provider, securing institutional terms to fund real, tangible infrastructure.
Let's pivot slightly to their other major target, because it really connects digital infrastructure to physical infrastructure. Berkshire built their Delta Airlines position up to $5.4 billion. And this isn't just some lingering pandemic recovery play. Adding over 17 million shares signals incredibly high conviction in the long-term durability of travel demand. They seem to be viewing best-of-breed carriers like Delta as industrial transport monopolies that are going to generate steady cash flow through any cycle. And hey, by the way, if you like deep, evidence-based investing breakdowns like this explainer, make sure you're subscribed.
You really can't fully grasp these massive equity bets without looking at how Berkshire structures their overall risk. You can see their ultimate risk management tool in action right here, the barbell strategy. On one side, you have a concentrated $299 billion public equity portfolio. But on the other side, a staggering $364.7 billion defensive buffer of cash and T-bills. Having a fortress balance sheet like that is exactly what allows them to take massive, concentrated swings without ever threatening the survival of the company.
But here's the reality check for any retail investor looking at this data: beware of the copycat trap. By the time a 13F filing like this actually becomes public, it's already 45 days after the quarter ended. The market has moved. If you try to blindly copy these trades today, you are almost certainly paying a premium that Berkshire completely avoided, meaning you entirely miss out on that negotiated margin of safety they secured, especially through things like that private placement.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free.
If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, plus Insider IQ, tracking meaningful insider buying activity worldwide.
You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, so rather than just copying trades, let's use this filing as a practical roadmap for what to research next. Berkshire's actions suggest we should be investigating how massive AI capital expenditures are actually translating into durable cloud revenue. We need to analyze digital utility margins to figure out if these investments are self-funding. And we really need to evaluate cross-cycle moats, like high-barrier transport and land-light homebuilders, to find businesses capable of surviving any economic weather.
Which brings us to arguably the most important question you can ask yourself. What is the market currently worried about that Berkshire is happily capitalizing on? Right now, Wall Street seems pretty terrified that big tech's record AI spending just won't generate enough near-term returns. That fear actually drove Alphabet's valuation down to around 25 times forward earnings, literally below the S&P 500 average. Berkshire saw that fear, spotted a glaring mispricing, and bought the infrastructure while everyone else was busy panicking about the cost.
The broader investing lessons here are just profound. First, holding cash for 14 straight quarters proves that absolute patience is a massive competitive advantage. Second, maintaining that cash barbell ensures you never have to sell your winners during a market panic. Third, seeking a margin of safety, sometimes even negotiating it privately, is how you protect your downside. And finally, slashing billions in consumer finance just to buy digital infrastructure shows that capital reallocation needs to be completely ruthless. You absolutely have to fund your best ideas.
So looking ahead, what should we be eagerly watching for in the next quarter's 13F? Well, we need to see if Greg Abel and the team continue this Alphabet accumulation pattern or if they consider their position fully sized. We also want to monitor if they keep trimming legacy financial holdings like Bank of America to fund new infrastructure bets. And perhaps most importantly, we need to see whether other institutional superinvestors start following this exact pivot into digital and physical infrastructure.
Let's quickly recap exactly what happened here. 1. A historic $17 billion tech pivot has definitively ended a 14-quarter cash hoarding streak. 2. The sheer size of their conviction was proven by a unique $10 billion private placement to fund Google's AI build-out. And 3. Because of that private placement and the 45-day reporting lag, trying to directly copycat this 13F filing is a dangerous trap. This isn't just a buy list. It is a massive signal of where long-term structural value resides.
Berkshire's transition from passive accumulation to active deployment tells us that they finally see opportunities that are actually worth their capital. So, are you just reacting to the headlines, or are you actually learning from how they size positions and structure their risk? If you want the full research, including the deeper framework behind this explainer, you can get it at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.